Alright guys, so the Eurozone is getting desperate, and when you're desperate, you tend to do really crazy things. Things that seem great in the short term but are absolutely horrible in the long run. And as you'll see, Europe is about to make a major mistake that could trigger a massive trade war with China. And this move stems from a deadly mixture of fear, anger, and hubris. And because of their energy crisis, Europe is still facing a persistent inflation problem. The majority of EU countries are still well over 2% inflation. The biggest economies like Germany and France are near 3%, which means rate cuts won't come until June at the earliest. And there's another energy crisis looming. Ukraine is now refusing to renew the flow of Russian gas to Europe by the end of the year. The contract is about to lapse and Europe themselves doesn't want to renew it. So gas from Siberia flowing through Ukraine will stop. While that will impact Russian revenues, it could throw Europe into another inflation crisis from higher energy prices. Austria, for example, still imports the majority of their gas supply from Russia. Just December last year, it was at an astounding 98%. This allowed Austria to become a net exporter of Russian gas, supplying their supplies to the rest of Europe. However, this is going to change. With the pipeline through Ukraine closed, the EU will have to buy more LNG from the US or the Middle East, which means additional costs on their imports. And that's terrible news for the economy, which is deindustrializing and facing endless protests from the farmers. The pain is not over yet, and even today, they are still scoring own goals to desperately cut away Russia's revenues. And as you'll see later, that probably isn't working well. So you can sense the level of hopelessness in the EU. Official forecasts are pegging GDP growth at just 0.8% in 2024. That's a significant revision down from the previous estimate of 1.2%. There's a level of distress that's just seeping out from Europe. They know their industries are collapsing, they can sense the world shifting investments away from the Eurozone, and frustration is starting to set in. In a lucid moment, we have the Minister of Economy in France telling us the truth. No one can accept European growth being below US growth. No one can accept the perspective for growth in Europe as either recession or stagnation. The situation is so bad that even companies are breaking away from the official line of the government in Brussels. And by now we know the decoupling narrative, right? That companies should get out of China and cut trade dependence, but that is simply not happening. Just last year, we saw German companies plowing even more money to China. Direct investment from German brands reached a new record high of 12 billion euros in 2023. Despite the calls from Olaf Scholz to cut away China, companies on the ground understand Beijing has two key advantages Europe simply doesn't have: the ability to manufacture at cost-effective price at a large scale and a big market to sell to. But what the EU is about to do could trigger a complete decoupling with China. Instead of solving their energy problem, they are looking to destroy trade relations with their biggest trading partner. Europe is about to hit China with tariffs on their EVs as soon as July. They are unhappy that China is subsidizing their EVs, which is resulting in cheaper cars. Now, slapping additional duties on Chinese imports is a very slippery slope. This is how trade wars eventually happen. The US started off with higher tariffs for Chinese goods, and look at the mess today. It has evolved into technology bans on cheap imports. What Europe is trying to do is to protect what's left of their manufacturing base, and they are doing it at the expense of the European consumer. So if you're in Europe and you want an EV, prices will be going up for you. And here's how big the disparity is. In the UK, the Chinese BYD hatchback starts at only $33,000. That's 30% cheaper than a German equivalent manufactured by Volkswagen. And as we move towards a global recession, price absolutely matters. The cheaper product of the same quality will win. No one really cares about branding during a global slowdown. And this is what's frustrating the Eurozone. This is pushing them closer and closer towards a trade war with China. EV imports from China were over 13 billion euros last year. This is demand or money that isn't flowing to EU companies like Mercedes or VW. And if this continues, if the price disparity is just so high, it will trigger an exodus of EV makers away from Europe towards China. Companies could just close shop in Germany or France and open a factory in the east. The Eurozone accounts for a third of China's total EV exports to the world. In under 12 months, exports to Europe have almost doubled. And if this continues, a huge portion of the European market will be taken over by the Chinese. So the EU is becoming protectionist, which could collapse EV revenues for Chinese companies, at least in the short term. However, the logic just doesn't make sense. By imposing tariffs, Europe is going to force consumers to buy locally but pay more. Instead of solving the root cause, Brussels is going after the symptom. However, that will just make things much worse on a diplomatic and financial level. If we look at the trade deficit between the EU and China, yes, it looks really terrible, coming in at 291 billion euros. Europe is importing more from Beijing than what they export out, and that's why the deficit is just so high. Now, it's true that the deficit is coming down, Europe is exporting less from China, but there is a limit to how much you can decouple. The EU imports more than just EVs, they bring in a lot of raw materials necessary for their own industry. Europe depends on China for key imports, and this includes electrical machinery, nuclear reactors, organic chemicals, and plastics. And because prices are deflating in China today, Europe can buy them at a discount, and this helps prevent a total margin collapse in manufacturing. So just imagine if China restricts these goods or places export tariffs, import costs in Europe will go up. And if Beijing decides to slap its own import tariffs on Europe, it's game over. Consumption in China will shift domestic, and it will be the EU industries that will hurt even further. Europe is afraid of losing $7 billion in profits to Chinese EVs by 2030, but the blowback effects could be much worse than just 7 billion euros. This is a dangerous road Europe is going to go down, and a trade war might be the final destination. So this is going to accelerate decoupling between the West and the East. It's going to push China closer to Russia as well. And speaking of Russia, this is a big trigger that's setting Europe into total panic. And let's talk about it. Now, the game plan was simple: slap a ton of punishments on Russia and impose price caps to sanction away their revenues. If we keep this up long enough, the Russian economy will collapse and Putin will be forced to surrender. But if we look at the data, nothing could be further from the truth. The majority of the world doesn't really care about sanctions, and Russian profits from oil aren't going down. Russia's oil and gas revenue jumped in February, boosting income into the country. The budget revenue has surged to almost 950 billion rubles, or $10.5 billion. And this is freaking the West out, especially Europe. Russian revenues aren't collapsing, and the war chest is still being filled up. This battle of financial attrition is turning, and we can see them already conjuring desperate strategies like the Crimea bridge attack. The budget revenue has flown up in February by over 80% versus a year back. Even after the price cap in December 2022, the revenues are starting to stabilize back to the pre-war levels. This is even as the price of crude has fallen from the peaks in 2022, which means further price caps or enforcements won't work. That experiment has effectively failed. Russia has figured out a way to keep the oil flowing and the profits high as well. Russia has set a so-called price floor on the revenues from their producers. This means no matter the fluctuation, government revenues will continue to flow indefinitely as long as there are buyers. Russia has set a baseline or price floor to calculate taxes on the producers. It's at $15 today, but it will narrow down to $6 in 2 years. In this chart, we can see the market price of euros in black versus Putin's price floor in yellow. If the market price is higher than the price floor, Russia will tax producers based on the black line, which is the higher price. However, if prices starts to fall enough, Putin will tax producers based on the price floor in yellow. This happened back in January when euros fell to $64 in the market, but Russia still taxed their producers based on $65. So this shortfall is up to the producer. They can either try to sell their oil higher or eat into their own profits. Either way, Putin still gets his taxes. And this mechanism allows the Russians to refuel their war chest indefinitely and force Europe into a long protracted war. And to fight on, more money has to be taken away from their economy. So the level of panic in Europe is building fast. There is no way to fully sanction Russian oil. The main buyers are no longer the EU or the G7 countries. That lever has been pulled and there's nothing else to play there. According to Novak, around 90% of Russian exports flow directly to India and China. So if you want to crush Russian revenues, you need to sanction both India and China. But as we know, that is simply impossible. It will plunge the global economy into an instant recession. It might even trigger World War III, and that isn't an overstatement. They are effectively trapped. But perhaps the biggest factor is Europe's big move towards a war economy. And we mentioned a while back that Europe has no choice. Even though their industries are collapsing, there's still a need to build their military industrial complex. And it's all because of Donald Trump. He's coming back and Europe is very afraid. Nikki Haley, the last Republican contender, has dropped out. It's going to be a Trump versus Biden rematch in November once again. And considering the dark speech Biden gave during the State of the Union, it's very obvious who America is going to vote for. If or when Trump wins, he could immediately stop funding to Ukraine. And if American involvement ends, this will be unthinkable to Europe. They have to pay a ton of money at a time where they can hardly afford it. They'll go broke. The contributions are very clear. While the US is the single biggest donor at $68 billion, the EU has coughed up $85 billion plus another 50 billion euros are on their way. That's a grand total of $140 billion in the hole. Folding their hand now means losing everything at the poker table. So they have to double down even further, and that will cause a ton of financial stress. The EU Commission is proposing to start the Eurozone war machine to move away from US weapons and to aid Ukraine. They are presenting a strategy that includes almost $2 billion in subsidies. Now, this might sound like a great idea, weapons made in Europe, but there's still the fundamental problem of higher input costs. Even though you have subsidies coming, the input costs are still extremely high. Making weapons in the US is still going to be more efficient than in Europe, and even if they want to make it happen, the cost will be exorbitant. They will dig themselves into further debt. Just to hit their spending goals by 2030, many EU countries will be facing huge fiscal deficits. This is money that exceeds the budget, money that they just don't have. Germany will have to spend an additional 3.4% of GDP, France almost 4%, and Italy nearly 6%. The defense spending in blue is just to hit NATO's 2% target. The interest payments on the existing debt and aging costs are also growing exponentially. Piling on the shift to a war economy is going to increase the fiscal deficit, which means either more taxes on the people or issuing more bonds to borrow the money from investors. And this might be the perfect excuse for the centralization of power. If the individual EU countries are just too broke to fund this war economy, Brussels can do the heavy lifting. Europe can outsource the burden to Brussels by issuing euro bonds or finance the spending through the European Investment Bank. And on the surface, this sounds like a good idea, but whether you borrow from the Euro Bank or you sell Euro bonds, eventually you need to repay the debt back to Brussels. And that could mean a central tax on all of Europe to fund the repayments, which would mean giving up more financial sovereignty to a central authority, the ECB. And this is even worse than the Federal Reserve System. At least Jerome Powell can't issue bonds through the Federal Reserve. They have to do it through the US Treasury. So you can see how dangerous this plan is. Europe is shackled when it comes to building their defense industry. The only way to do it is to get into terrible amounts of debt or give up more power to the ECB. So things aren't looking good for Europe today. We are witnessing a wave of desperation that's leading to really dangerous decisions. And at the center of this is the trade war with China. The problem with tariffs on Beijing to save European industries is not a long-term solution. You'll just increase inflation on the ground. Meanwhile, China will simply export more stuff to the rest of the world. Even though the West is decoupling away, China's exports actually grew by 7% from January to February this year. This isn't domestic demand picking up the slack, but foreign demand importing more Chinese goods. Slapping tariffs on EVs might hurt China in the short term, but trade will reroute to other parts of the world. There's still Russia, Asia, and the rest of the BRICS countries to sell to. So fear and panic has truly overtaken Europe. Cheap energy is gone, and the only way left to survive, at least in Brussels, is to launch trade wars. And this is a very dangerous gamble that just won't work. But let me know what you think. What is the EU really thinking? And will this backfire badly? Let me know in the comments below. Stay safe, be sure to smash the like button and subscribe as we navigate through these crazy times.